Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Hi, everyone. We are back with the 22nd episode of Carson's Facts versus Feelings with Ryan and Sonu. An extremely special guest this week. I know we teased him last week. How excited are you? No, let's not say who it is yet. Let's not. Well, you know what? If they saw the title list, they probably know. But how excited are you, Sonu, for today's guest?
I am. You talk about, what's happening in markets and prices and stuff like that. So it's always fun to talk to someone, like yourself, right, who's so steeped in things like sentiment and what prices are doing and breadth and momentum and all of that. So, yeah, that's exciting. Just for that.
What's the podcast where they have the three guests and they bring someone on, they don't tell them who it is. What's that one called? I forget all of us.
Are we doing that for the whole episode?
No, because we'll give up who it is. It'll come to me. But anyway, that's a real anyway. Without further ado, straight down from Sarasota, where probably one of your grandparents live, Ed Clissold from Ned Davis Research. Ed, is it true your grandma lives right down the street from you down there? Is that necessary in Sarasota?
Or in Florida?
No, it's pretty true. When my wife and I moved down here 20 years ago, we lowered the median age of Sarasota County by about 6 years. Yeah. So but it's actually getting younger. It is since the pandemic, there's been a lot of families who have moved down here. Demographics are changing. I think, unfortunately for us, the secret's out. It's a great place to live.
I love it down there. I've been there many times. It was Smartless.
Nice.
The podcast I was thinking of was Smartless, where the guys have a special guest come on. But we're not going to promote too many other podcasts. We're going to promote ours this week. Yes. First things first, Sonu. Well, Ed, you're in the hot seat. This will be a nice hot seat, I promise. We're going to have a lot of fun. Sonu, you want to start with the first question, then I'll pepper them in from there.
Yeah, you know what? Let's maybe just start at basics, right? Because, there are a lot of folks who listen to this podcast. I was just talking to you guys about my wife listening to it. Mm-hmm. So let's talk about technical analysis. What is it, right? Why do you think that's important, right? Why follow prices at all?
Yeah, the way I think about it, investing is like driving a car, but you have to be looking out the rear view mirrors, right? You really don't know what's in front of you, just having to look at information that's already happened to try to gauge where you're going. And look, the fundamentals, earnings and macro, all that's very important. But that stuff, by the time you get that information, by the time a company reports earnings, by the time you get the economic release, that's way in the background. So okay, I'm going through mountains, I'm going through a valley, I'm going through Kansas, clear sailing. But the technicals are the stuff closest. That's the price actions happening right now or just happened. And so it's going to give you the best information. And, so many times when there's a major change in the cycle, the prices tell you first. And then later on you go, oh, okay, that's what happened with unemployment, or that's what happened with company XYZ. And so it's really about getting really good information first.
No, I've said this one before, where I think June or May of 2020, we had some of the worst headlines in our country's history. Millions upon millions of people losing their jobs. Yet the stock market had like a 10% rally, right, in May of 2020. I think that's a good example of that. Ed, so we started with that one. Maybe let's do a little more groundwork. Tell us a little bit about yourself. How long have you been with Ned Davis Research? By the way, Sonu and I are huge fans of yours. I've read your stuff for years. I always get something out of it, and the whole team at Ned Davis. Although, given you're on my podcast, I'll just say this amongst friends, you're my favorite. But no, your work is awesome. How long have you been there, and kind of what do you do every day? Exactly.
Yeah, well, I'll tell my colleagues at Ned Davis Research that Ryan says, because Ryan's name carries a lot of weight at NDR. He's one of the clients who knows our stuff so well and thinks likewise, and so it means something. But so I've been at NDR for a little over 20 years. I was actually a client beforehand, and I was actually at a brokerage firm called J.C. Bradford. which was a regional brokerage firm, which is where Ned was before he started Ned Davis Research. So Ned was this like mythical figure that people would talk about. Markets got volatile. What does Ned think? What does Ned think? And I had more and more interactions with the team at NDR, and I thought, wow, that would be a fantastic place to work. And so when our company got bought out, I went to graduate school and then spent 2 years kind of thinking, wow, I still would rather work at Ned Davis Research and all these wonderful companies I'm interviewing at. So I was lucky enough to get a job there, and been there 20 years, studying markets. And the best part about being an NDR is that we have so much data and our own software system to analyze. It's like a kid in a candy shop where you can just, come in, you have the question, you kind of wondering, like, I wonder what that really means. Well, we can kind of answer it. So it's kind of a cool experience.
One more quick one for me, and I'll let Sonu go. Is it true you started as a quant person? I think I heard that maybe for you or someone. You started in quant and then kind of worked your way into more of a market strategist role?
Well, yeah. So we have a custom research group at NDR, which is very quantitatively oriented, and that group will build custom models for clients. And so I started off in there and did that for about 2 years before I moved. And so it really, in fact, a lot of people at NDR start off in that route because it really gets you ingrained in the important way to do research, and then you move on from there. So I think if you were to read my reports, I think that's probably comes out in the process orientation of the reports, or hopefully
it does. Sonu, go ahead there.
I'm just going to ask a big question. Like, what do you think of markets today? What's going on?
Yeah, so I think there's a really interesting dynamic that's gone on over the past several months. We kind of alluded to this earlier, where there's this logjam of terrible macro news, fastest Fed tightening cycle in 40 years, yield curves inverted, that always seems to lead to a recession. The bear markets have never ended before the recession has started, therefore we should have new lows. All these things are kind of telling us, wow, more trouble ahead. But really, since June, the technicals have been getting better. And I'm actually a CFA. I don't have a CMT, but I feel like I'm a practitioner. But I joke with my CMT friends at NDR, like, this is going to be on the CMT exam in 5 years, like what a bottoming process looks like. We're going through a classic technical bottoming process over the past few months. And so for a long time, it was like, which is going to win out? And over the last 6 weeks or so, it seems like the bulls are winning the battle, at least for now.
So, you guys do amazing work with breadth thrusts. I've played with some of these ideas and talked about some of these things. What exactly is a breadth thrust? And we've seen some lately that, again, is that kind of helping you understand, listen, the news is the news, the Fed is the Fed, but the market's message is something stronger. Do you want to build on that?
Yeah, so breadth thrust is a funny term. I don't know who came up with it. No technical analysts have come forward and said that was mine. So we'll leave that for mysteries from here to eternity. But what it really means is you're going to get a very high percentage of stocks rallying at the same time. And the reason that's important is, let's say a few companies have their own specific problems, or an industry runs into trouble. There's still lots of other stocks that are in uptrends. So that allows the popular averages to continue to move higher. So a real simple example is that if you get over 90% of stocks above their 10-day moving averages, that's a breadth thrust. So if you look forward a year later, the vast majority of the time, the market has been higher, and higher by a lot more than your typical 7-8% you get in a given year. Now, where things get tricky, Ryan, is that these have become a little bit more common. So we got a breadth thrust in October. We actually also got one in August. We got one in June. We got one in March. And so so some people have said, well, let's just ignore these. Obviously, there's a problem with the market with the way these indicators are working. I said, well, no, they've continued to work. I just think we have to be a little smarter about how we use them. So I think what's happened is there's underlying structural changes. So first of all, 30 years ago, you were bullish. You bought 5 bellwether stocks, right? You bought GE and Exxon or something. Now a click of a mouse, you buy 500, no commission. The other thing is that when I got started in the business, we actually traded in fractions still, believe it or not. You had to know 30 seconds and 64ths. But that meant that 20% of stocks were unchanged on the day.
Mm-hmm.
Now it's only 2. So it's easier to get an advancing stock or declining stock. So we say, well, we still trust these breadth thrusts, but let's look for more confirming information besides just going with them.
It's fascinating. It's so interesting. I was going to ask, like, when you look at price and breadth and all that, it's essentially you're thinking about like, oh, this is a sign of investor sentiment. But you had a wonderful note this morning about, or I should say, yeah, well, this morning, about sentiment, right? And so you look at a lot of sentiment indicators directly. What is sentiment telling us right now, and why do you look at sentiment in addition to prices?
Yeah, so sentiment is really, it's telling you how people feel. I think you can kind of put it in 2 buckets, right? The surveys, what people say, and that's actually very important, but also what they're doing. Like you look at
Right. Yes.
flows into different funds. Some people say, "Oh, I'm bearish," but you're still piling money in. Well, how bearish are you really?
Yeah.
So we look at all of it, and sentiment can be a wonderful contrarian indicator. That is, when everybody gets on one side of a trade, then the next piece of news that goes contrary to that is going to actually move the market the other way. I think we got a great example of that over the last few months. We have a sentiment composite of about 7 or 8 different indicators that was showing extreme pessimism from early April up until like kind of late January. And so it kind of narratively, you think, well, anybody who was concerned about the Fed or inverted yield curve, recession, inflation, they had their chance to sell. I mean, if you hadn't sold yet, you probably weren't going to. So the next piece of incremental good news was gonna move the market higher, and that's exactly what happened.
It's like marginal news also counts, right? But
Yeah,
just
and
like
actually,
marginal prices.
yeah, the best time for the market is when things go from absolutely terrible to kind of not that terrible. Of course, that's a very hard part of the cycle to catch, but is when you get the biggest rallies.
I mean, and so is that kind of where we are now? What I mean by that is you follow this, and we talked about it before, but the AAII sentiment poll, 44 straight weeks of more bears and bulls. Just recently, more bulls. We're starting to see some optimism. I mean, Sonu and I are one of the, I guess, pat our back a little bit. We think Carson Investment Research is one of the few shops that's been saying soft landing or potentially no landing because the economy is strong for the whole time. The last 3-4 months we've been talking about this. Now lots of people are catching on. Oh, wow. Maybe the economy is stronger than we gave it credit. So things are getting better, I think, is what it looks like. Is that kind of where we are, that transition from really bad stuff, but now things are okay, but historically things are okay in a bull market? I mean, how do you see it now?
Yeah, so I think what has gone on is that the market got ahead of the economy by more than it normally does. So earlier I made this comment about the stat, so the stat that said the market has never bottomed before the recession started. So therefore, if you think you're going to recession, we need to break the October lows. Well, here's the other side of that. On average, the market peaks about 6 months before the start of a recession. Sometimes it's a little bit more than that, but normally in fact, the longest is about 17 months. So that was fine if the recession was going to start in late 2022 or even early 2023, because the peak was in January 22. But now we're pushing this out. If the recession isn't going to be till the end of this year or next year, I'm not predicting that. I'm saying that's where the market is starting to think. You just don't stay down that long. You can't keep a market down that long without actually having a recession. And so I think what we're doing now is pricing out the near-term recession risk. And who knows, maybe the Fed has to, can pause, hike later in the year. Maybe that's what causes the recession. But, crystal ball doesn't exactly go out that far. But for now, we're pricing out the recession. So I think the market just got, a little bit ahead of things. And then, maybe you guys are right. Maybe this is a soft landing. We go on from here, or maybe we just, we just priced in recession a little bit too soon. And the next down leg is, just comes later than what a lot of people originally thought.
Yeah, no, I mean, that's the way. I mean, again, it is the crystal ball, right? Like you said, it doesn't go out that far, but so you look at, like we do here, look at the data now and you think about, okay, what could happen in the near term, right? I mean, even 9 months is a fairly long way away, but or let alone 12 months from now, right? So, but on that, like, you always see, like, all of us are on Twitter and things like that. You always say, like, oh yeah, the yield curve is inverted, or ISM PMI is below 50, and ISM services PMI, forget what it is. I'm not even going to define any of these things for our listeners, but you get these one indicators and people dive on that and say, oh my God, this is terrible, right? How do you think about all of, the totality of data, to use, actually Powell used that term, the totality of data, which I like, but that's something similar to what you guys do, right? You look at all of it, and, or is there anything, are there certain indicators you prefer over others, or how do you think about that?
Yeah. Yeah. So what we do is we put it in 4 buckets. So you have the fundamental, earnings and valuation, macroeconomic, so economy, Fed, interest rates, and those two things tell you how the market should act. And over the long run, it generally does. But as Keynes was famous for saying, the market can remain irrational longer than you can remain solvent. So that's where you also look at the technicals and the investor sentiment. And so we put probably more weight on the technicals than anything else, but we really look at all 4 of them together. And so I think sometimes if you just focus on one of them, then you're going to miss what's going on elsewhere. And I think that's maybe what some had maybe gotten caught up in, focusing on just the fad and missing that. So we'll want to make sure we take it all into account.
So Ed, I want to change gears for a minute here. You've been with Ned Davis for 20 years, obviously worked with Ned and some other really smart people on that team. Who's a mentor of yours you'd consider in your career, and what's something you've learned from that particular mentor?
Okay. Well, first of all, shout out to my father, mentor. He's in business for I guess he's going on 60 years
Wow.
now. So lots of, and he's one more even keeled people you'd ever met, which for anybody who's been invested for more than a minute knows that's super important. But along those lines, Tim Hayes is the global strategist at Ned Davis Research, and I got to tell you, from 07 to 09, we were like, is he a machine? Does he even have an emotion in his body? I mean, he was just so disciplined with how he called it, and getting negative in late 07. We got a lot of pushback for that. Market peaked in October. Stayed underweight all throughout 2008, and then turned positive the end of 08, early 09, as it got a lot of technical confirmation. And again, the pushback was crazy. So that kind, watching how you have to put your emotions aside. That was just a great example of how to do it. But there truly are just a great collection of minds at NDR, and I could probably go through examples from about 10 other people about just showing you how to do that.
Yeah.
And I just get one more without this turning into the Oscars, but Ned himself is just obviously a fantastic investor, but man, he knows how to treat employees and build a great business and instill loyalty and teamwork in people. In a business where almost by definition, the goal is to make money, and it's easy to be thinking about number one. He did a great job of building a team that does a lot more than that.
That was great. I will admit, I assumed you were going to say Bobby Knight. Let's see it.
Well, yeah. So for my IU days, I would say
to those listening, he's an IU guy. I got to give him this little segue for Bobby Knight. Yeah.
Although I'd say this much is, as an IU person, you really can't say anything negative about Coach Knight, right? But based on chair throwing and other activities, I wonder, how disciplined he might have been, managed his own portfolio. But I'm sure, but actually, in all seriousness, when I was in Bloomington, I could not. Everybody has a Bobby Knight story about how kind he was to somebody. This person needed help and all those sort of things. So not that Bobby Knight, everybody kind of knows on the surface. So maybe he was a closet fantastic sentiment trader.
Well, I'll say this: he's done some things.
I wasn't too far away.
Sorry, I'll just say this: he's done some things with Carson Group. Bobby Knight has. He and Ron are friends, and they know each other. And I've heard the same thing. Maybe on TV, he's one thing, but you get him away from the TV, and you get to know the real guy. He's just a very a pleasant, incredibly warm, thoughtful person. So yeah, kind of.
Yeah.
Go ahead, Sonu. Sorry.
No, I was going to say that I wasn't very far away, and those stories came all the way up to Purdue, which is where I went. So
Well, hey, this may be Purdue's year
yes,
for basketball. They
yeah,
might they just
very good.
might pull it out. Yeah.
Fingers crossed on that one. Yeah.
Yeah, maybe
So you're not supposed to
for
like
that
them,
you
right?
fanning me.
Yeah. So I'll jump in. I'll get us back on task, and we could probably do this all day. But the guys, everyone listening to this podcast, just so you know, we are recording this a couple days early due to the President's Day holiday and some travel next week. So hopefully the world doesn't go crazy by the time you listen to this. I mean, Ed, speaking of crazy. You guys follow sentiment. I mean, the whole balloon thing and the UFO stuff. I mean, I don't want to dive too much into that, but you guys have done a lot of work just on random stuff, right? Random things can happen to the market. Sometimes they're bullish, sometimes they're bearish. I mean, how concerned should your average investor be about UFOs or whatever the latest worry du jour is?
Short answer is don't get too caught up in it. We did this crisis event study, probably started 25 years before I was there, and we've kept it up. Where you take this, it takes an event. I mean, like for example, the Kennedy assassination, the market went down for a few days, pretty hard. But then if you look 6 months later, on average, you've recovered the losses. And so that information coming, the knee-jerk reaction, is usually not necessarily the correct one. And so, while it's fun to kind of hypothesize about whether or not, what if that UFO is actually a UFO or just something they haven't identified yet, is fun. But I'm not sure that should be something we should take too much consideration.
Yeah. One more quick comment. I believe Abe Lincoln put it best when he said, "Don't believe everything you read on the internet." I think is probably the best way to describe that. But anyway, Sonu, we've got maybe 6 or 7 minutes here. I want to make sure we keep our mark here. So Sonu, go ahead with another question for Ed before we wrap.
No, I'll just riff off of that, right? Like especially over the last decade, we've had like what they call like wall of worry, right? You had the one debt crisis after the other. So after the great financial crisis, then you had China, markets went up. Even COVID, right? So so I was thinking about you talk about crisis-led studies and think about what happens after the fact, and how do you talk to clients about stuff like that? Because everyone sees these headlines, right? Tech layoffs, and now it's tech layoffs, inverted yield curve, back to all that. There's plenty of bearish sentiment to go around, right? But how do you guys talk to clients about just sticking through it and watching prices, I guess?
Yeah, so I'll kind of give you two answers. One is this is where we have indicators and models, right? So it's not necessarily what I think. Let's look through this. So yeah, while the tech layoffs are in the news, what doesn't make a headline is XYZ manufacturer adds 10 new employees. And if you look at the jobs data in total, it's a very robust labor market. Mm-hmm. It's just the opposite of what it was during the shutdowns, where everyone's letting people go except for the big tech companies, and now we're reversing. The other thing is that with the advent of algorithmic trading and these kind of automatic trading systems that can really take over what happens day to day, it's hard to maybe say, okay, here's an economic data release, let me try to trade this. I mean, some people can do that, that's great, but computers really, they can absorb the information so quickly. But what the computers can do is sometimes like run themselves off a cliff. And they think the momentum gets going one way, and sometimes you what happens, you hit these air pockets, and that's when you want to take a step back, look at the indicators, and say, maybe the market went too far up or down, and this is an opportunity to add value, to your clients, or as an individual investor, this is why you keep a little powder dry for when you hit these air pockets. And so that's how we maybe adapted a little bit over the past 8 to 10 years to some of the changes in how the markets trade.
I like that. That's a nice way to think about it. Air pockets.
Yeah, that was good. So everyone, this is the 22nd episode of Carson's Facts versus Feelings with Ed Clissold from NDR. Man, this has been a fun conversation. So Ed, we maybe only have time for about 2 more questions here. I'm trying to think, what is one thing that maybe worries you? And don't say the internet goes out and your kids' devices don't work, because believe me, we're all worried about, well, the internet's down. Like, internet will go down for 5 minutes in my house. My daughter, who I don't see all day, she's 15, she comes storming out yelling at everybody. That worries us all. Let's be clear. What also is a worry, for the NDR team or yourself when it comes to investments, the economy, the Fed, inflation, any of it? What's one thing you think could upset the apple cart this year? Not your base case, but something you're thinking about.
Yeah, so our base case is that inflation actually comes down in the first half of the year and then maybe starts to move back higher, and that's where the Fed would have to re-engage and maybe tighten some more. So let's say inflation is actually stickier earlier, and the Fed doesn't pause at all, and they just have to keep going, and that would maybe they would in fact cause a recession sooner rather than later. So I think that's probably our number one concern. The other thing I'd say is that earnings expectations are too high. I think they're always too high. I mean, we kind of know after look at, but some years they're way too high. In fact, last year they were about, consensus was plus 15. We're going to end up around -5. That's a pretty big miss. Something like that to the magnitude like we had last year would be pretty concerning.
So I'll jump in. So, but that means that was down 20% less than expected. Is that what we just said? Up 15 to down 5. S&P was down 20%. Is it sometimes that simple, or is that kind of random how that perfectly lined up last year?
That's a little bit random. Yeah, usually there's some multiple. PEs go up or down.
Gotcha.
Yeah.
Anyway, Sonu, you've got one more question. I've got one more, and we're going to let Ed go off the hot seat.
No, I was going to ask about exactly what you just talked about with respect to valuations and things like that. I know you guys look at that, but maybe go the personal. What's the toughest call you've had to make? You've been at this for 20 years. What's the toughest call you have had to make? Like toughest in the sense, like that you were sort of second guessing yourself, but you stuck through it.
Yeah, so I'm going to tell you about the one that didn't work.
Okay,
no, I never,
don't say coming on.
Never do that.
Ed,
right? We always talk about the ones that
real
work.
Fast. Do not say coming on this podcast. Don't answer that. If you can answer, don't say coming on this podcast.
Yeah, that would have been a great answer. Yeah, no, no. So I picked up covering small versus large in like 2010, and small caps have been outperforming for a while, and we were thinking that okay, economy had come out of recession, which is usually when small caps do the best. Maybe it's time for that to roll over. And so we made a pretty big call saying we focus on large cap. This is not just a trade. This is something that's going to happen over the next few years. And then it started to work, and then rallied, made the small cap versus large cap versus small cap, made a new high for one day. And I remember just thinking, I can't believe I messed this up. And then that was it though. And so maybe because I was that smart, or maybe because I didn't have time to second guess myself because just one day. But then it's been large caps outperforming for 11 years since then.
Wow. Yeah. That's we do this for a living, and we all have to make those calls, and they can be incredibly uncomfortable sometimes. Sometimes we're right, sometimes we're wrong, but hopefully we're up front in how we see it at NDR, and hopefully Carson Investment Research are that way. So really, final question, Ed. This was a lot of fun. I mean, I know Sonu and I are huge fans. Obviously, the partnership with Carson Group and NDR goes back many, many years, and it will continue to go back. So just thank you so much for your time. How can someone follow you or the NDR team? What's the easiest way to kind of find some of the research you guys are doing, and where is it?
Yeah, so our website's pretty easy, www.ndr.com. I'm on Twitter at Ed Clissold, so pretty easy to find. And there's actually at NDR_research is the NDR Twitter handle. So would love to, people take a look. If you feel compelled, hit a follow button, and we'd appreciate it.
When's the next time you're on TV? I see you on TV every once in a while. Do you have anything set anytime soon?
Well, actually, so as of this, I'm actually going to be on Bloomberg tomorrow.
Okay.
So, but I probably before this pops. But I am set up to do Fox Business in the next week and a half. So probably a little bit after.
Okay.
By the
time people listen to it. Okay, cool. All right, Ed. Well, thank you very much, Sonu. Thanks as always, everyone. Thanks for listening. Carson's Facts versus Feelings, episode 22 is officially in the books. We'll see everyone next week. Thanks again to Ed and the whole team at NDR, and thanks, Sonu, as always. We'll chat then, guys. Have a great week. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Dietrich are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.